now isn't the time, in my opinion, to lock in.
I mean, you should have done it in the past, but I don't think we're anywhere near. I don't think you're anywhere near the top.
I hate that argument of like should have done it in the past. Like they were literally saying we're not going to raise the rates, and so you would have to have been like, I believe that Bank of Canada
there was no way to know. But my thing is, you're coming, in my opinion, honestly, coming from a place of comfort where it's like, if those rates go up, you can service that debt as those rates go up. I don't think a lot of people have that comfort level to service as it goes up.
Dude, if you can't service 3.2, how are you going to opt into a voluntary 5%?
I'm not saying no. I'm not saying they can't service a 3.2. What I'm saying is if this goes up another 200-300 basis points, and now this is 5.5, 6, 6.5, 7, then they can't do it.
When I was broke, I had rich habits. When I was broke, I had rich habits.
Welcome back.
Welcome back, and welcome for the first time, those of you who haven't tuned in before.
True.
Yeah.
We're bad for that. Master Keys Podcast. I'm Neal and
I'm Chandler Halliburton. This is episode 25, which means we're halfway through the year.
Yeah.
Great time for you to check out the brand new like button that they've got apparently on YouTube.
Bad time to be getting a loan.
Bad time, terrible time in all kinds of respects, but the like button has much improved. Check it out.
Subscribe.
Follow. I don't know if they changed the little bell ringy thing. Only one way to find out people.
The bell ringy thing.
Click it. Click on that bell ring.
Subscribe ringy thing.
Yeah, thanks for all of you out there who are following along. We got crazy stuff going on this week. Every week things get crazier. The Fed, which is the U.S. central bank, jacked their target rate by 0.75, which has made it a little bit easier for the Bank of Canada to go, maybe us too. Mm-hmm. Even though everyone was thinking it was only 50 basis points, which, to be clear, 50 basis points was like the biggest increase in the Bank of Canada rate in 20 plus years. And now they're like, 50's easy. Let's see if 75 will break anything.
It's been the 90s since they did it 75.
So that's crazy. Also, a lot of stuff locally.
Yeah, so locally there's some changes on immigration, which is insane.
Yep.
Then there's some other stuff going on in the metaverse.
Ooh,
some castles being built, some big brands making some moves.
Yep. Bitcoin getting trashed, Ethereum, all the crypto space is getting destroyed.
Yep. I don't want to say we predicted, but I think we may have talked about this a few podcasts ago, why it's always good to listen.
You know what? I was saying I wish we cataloged some of our back episodes because there's nothing better than going back like, see, we told you so.
Yeah.
But we got all kinds of stuff. We're also going to talk more and more about inflation and rates. Specifically, I've been getting, I'm sure you have as well, questions about do we go variable, do we go fixed? Do we go variable, do we go fixed?
We have disagreements on this.
We have some disagreements on that, so we're going to unpack it. But I think it also is worthwhile to spend some time explaining to people how these rates are actually set. Like if you have a variable rate, we're going to talk about how that rate is set and what these central bank rates are.
At a digestible level.
At a digestible level, and we're going to save that for later. For
interest rate articles are a little bit boring.
They are, and me explaining them is probably even more boring. But we're going to do it anyway because, so any of the nerds out there who are into, like, how are these interest rates actually set, check out for that. And tons of stuff going on in the market that we're going to talk about. Not a lot of it good, most of it bad. Yeah. What's it going to mean? But as always, what's shaking?
Not much.
You've been slow news-wise, but you did have a nice little purchase. What did Neal buy?
Oh, we're talking about the car?
Yeah, I'm talking about the car.
Oh, okay. I bought a car. Everyone, actually, it's funny that I'm starting to have some people message me about cars more so than real estate.
Yeah.
But I just bought a little Mustang, manual Mustang. It's like a 2012, and I'm turning it into a drift car.
Neal's a little young to be having a midlife crisis here, but he bought himself a little Mustang convertible.
I've been having it, and it's an older car, but it's stick. And basically, I went to drift school there a few weeks ago. I can't remember if I mentioned it on here.
Yeah,
I think I did. And I loved it. I thought it was so fun. Like, drifting is kind of an art. It's not like you're not worried about your times and this and that. It's kind of about how much fun you can have ripping around certain things. Mm-hmm. And so I bought a drift car. I also will preface this with, I went to drift school because I crashed my last car trying to drift.
Okay.
And so I figured it was time to get some professional help. And so I did that. And now, so I just bought this. I got it today. I'm getting the diff locked and welded for anyone who knows what that stuff is.
I have no idea what any of this means.
And I'm going to put steering spacers on it. Long story short, it's going to do sick burnouts and slide around and make a bunch of noise.
Just when you thought Neal couldn't get more obnoxious. Just kidding.
Yeah, exactly. I got a Master Key sticker going on the door.
I just would love to see just drift up to a tenant's apartment building. Just like rip around the corner, like slide.
In my true fashion for buying vehicles, though, I think I got a smoking deal on it.
You did get a smoking deal. In fact, I think you might sell it to me when you're done with it.
Exactly. It's going to be great. I'm going to hoon it all summer, and then I'm going to sell it to Chandler at a profit. It's a win all the way around.
Things are coming up, Neal. No, that's good. What about in the real estate and investment world? What's going
Real
on?
estate.
Remember that thing we used to do?
The thing I used to do back in the day. Again, I am the lamest, most boring person right now. All I am doing is I am parking. I'm not buying anything unless it's a crazy deal, and there's no crazy deals coming across my plate right now. There's lots of deals coming across the table, but they're all, I find, overpriced, and it's funny to see everyone's dropping their prices. Like I found 3 months ago, someone was like, "Oh, I want $2 million." I wasn't even asking them. I got another text. I would do 1.8. But when we had it under contract for $2 million. We went back for 1.8. Hard no. Right? Got another one, same deal. They dropped 10% in price. It was a $5 million, and they're willing to drop 10%. And so like, there's a ton of stuff where people are kind of starting to question it. And I mean, we'll again go further into this interest rates and why they're doing that. But it's interesting to see. And so I'm kind of pumping the brakes, and I'm super hard on trying to get my rentals done. It's all pressure on trying to get people materials. But what, it's funny, I think you mentioned this, is I found there to be a little bit more availability.
Yeah, a little more availability, and also some tradespeople asking for their money a little quicker.
I've definitely been getting hounded for money a little bit quicker. And also, I had some people quote some stuff today that can start tomorrow. And I'm like, I haven't had that in 2 years, 3 years.
Wow. Yeah, that's...
and the price wasn't too bad.
That's promising. We talked lumber, I think, is down 50% in the last 3 months or something like that.
Yeah,
and
roughly.
I don't know that has trickled down to the Kent or Home Depot prices that us as a consumer get because they've got their back inventory. But things are trending that way. I love hearing that. Yeah. And this also, everyone that is like, yeah, bring on that great reset. I hope things fall apart, blah, 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 blah. They're talking mainly from a place of real estate frustration, where they want this collapse of the real estate market. They do not understand everything that goes along with it, which means their job may be gone as part of this great reset. Or say they're a tradesperson who all of a sudden is available and willing to do the work for less than they were, a few months ago. So it's not like any great reset that some social media warriors are clamoring for.
Everybody's going to feel this.
Everyone's going to feel it for sure. Yeah. And if we've looked at any resets in the past, you don't have to go that far because you can consider the start of the pandemic a reset. It tends to work out best for the people who have a lot of money.
I was just about to say, and everyone hates the 1%, and this is who they're hoping the Great Reset hits the hardest.
It's not going to hit them.
It never. Yeah, exactly. They have the wherewithal and the ability to just outstand it, and then they have the ability to make the investments and the purchases when things are down to capitalize on the new growth that comes to be. So, yeah, in general, 100%. We just need to be more cognizant. And
we haven't done the full conspiracy episode yet.
I'm dying,
but we might get into that a little later in the episode if you want to hear conspiracy, because I'm jumping on board almost 2 feet. But we got a lot to talk about between now and then.
Go.
So you're not seeing any hot deals?
Not
but there
really.
Must be a threshold. Like a deal might, come along.
There's some that are okay, and I'm like, if things pan out, and I put them at higher caps at the end, and I run worse interest rates, and I'm like, well, they're still not bad. But like I said, it's just pretty nerve-wracking, especially where similar to you, I think I'm trying to make the leap from small 3-story wood frame multi-units into a real building, and just the multipliers on the numbers become so much more that I'm like, man, if this misses, it's 7 figures, if you miss by a point.
Yeah.
And so yeah, I'm in a very awkward position. And the other thought is if you're smart with it during this time, it might allow you, whatever stage you're at, to jump to the next step. Let's say right now you're buying duplexes and triplexes and single family homes, and you're really wanting to get your first purpose-built multi. I think within a year's time from today, there might be an opportunity for someone who needs to get rid of their multi-unit. Yeah. And you might be able to get in at a reasonably good deal that you couldn't have gotten in the spring of this year.
I agree. Yeah.
And I think there's going to be, from those guys going in those mid-frame wood frame multis that want to go into a bigger purpose-built or into a development play, there's going to definitely be some people that need to offload chunks of land that you will get great deals on, and this might give you an opportunity to do that. So
they'll have to be a great deal, because if your rate is higher and your debt service ratio is changed, it'll have to be that deal. And that's why it's some of it is being quote unquote opportunistic, but some of it is going to the seller and being like, yeah, I can't get the money you want for it. It doesn't exist out there in the lending market.
And this is something I want to talk about. I think we talked about it a bit last time, and this is the part that you need to consider. Not everyone's just going to hold through. A lot of people think, well, just hold out through it, the whole thing. If any of them have a renewal during this time, which I'm guaranteed there's lots of people who have renewals during this time, there's 2 things that are going to happen. they're either going to be like, wow, I'm rent capped at $700 a month per unit. And now when I do my renewal on the current mortgage that I have, not adding any value to it, I am now
just wanting
super negative cash flow.
Yeah.
And I'm not really interested in carrying this anymore. And I can't increase my rents to cover any of this cost. Or if they had recently remortgaged and they have to do a new renewal that's 1 or 2 years up and the debt service doesn't hit anymore, the bank may force their hand into selling the property or say, hey, look, we're only like, we know we extended $2 million to you on this property. Now, due to interest rates being up 2.5%, we're only willing to extend you 1.7 million. So you need to give us back 300 grand.
Yeah.
To keep carrying this property. And I think there's a lot of refis that went through in the last couple of years.
Yeah, that's when the refi works the opposite of the way you're hoping. It's a refi where you don't take money out. It's a refi where you get to put more money in.
Yeah. So
someone, actually, shout out Igor and Scott from the Bentley Group. If you look back on our episodes, you remember when Igor came in, he's a mortgage broker here in Halifax. I've been talking to them a lot about this interest rate stuff because they're obviously very knowledgeable, and I find it super interesting. And Igor and I had this conversation about, he kind of asked you, like, as a person who owns real estate, like, what do you think about the future? And we've talked about this a little bit, and a lot of these ideas aren't fully, formulated yet. And I feel a big security of, and I feel very fortunate that I have my piece of the pie, right? It's better to be in than not in right now. Regardless, even if the market is going down, it's better to be owning real estate as it goes down than not owning real estate. And I don't care, everyone out there who's trying to sit on the sidelines and think this could be a buying opportunity. It's like, well, you'd still rather not have the transactional costs and the uncertainty of not owning anything at all right now.
Yeah.
Long term, I can see a situation whereby they really crack down on the ability to refinance. And if it becomes a situation where you have to carry a minimum of 35% equity in every property at all times, will that stifle growth? Absolutely. Will it be a bit of a bummer, for lack of a better term? And however, on the flip side, then all the properties are going to cash flow better. So if they're going to try to implement some fiscal or monetary policy whereby, we're going to protect Canadians from themselves and make sure that they don't have over leverage, well, then there's opportunities to make more money month to month.
There is more opportunities to make money month to month, but all it really does in my eyes is it makes it more difficult for the next set of people to try and grow through the systems.
Oh, yeah.
It's like when you look at the previous generation, they were offering 100% loan to values and this and that to make things happen and projects and on and on and on.
Yeah.
Now, as they continue to add more rules, more requirements, debt service ratios, they go like worse and worse on the leverage ratios. To make the leap to go from owning houses to owning purpose built to actually building buildings will be so much more difficult. Like that's going to think about that when they won't be able to refi out that money.
Oh my God. Oh,
how in the world? It's going to become a time game. It's like, okay, so now I have to. Takes 2 generations to get the cash together to actually buy and build a property.
And they will quickly realize, well, the month to month profit may be better, but it's not going to be enough to make a living off of.
Yeah.
And so they will sell, and who will they sell out to? There's a very small handful of corporations, not people, that can en masse acquire properties, and or Blackstone, that can acquire these holdings with that sort of equity requirement.
Yeah.
And listen, we're going to do a conspiracy episode. Are you ready for our next episode where it's going to be all conspiracy?
I'm literally a conspiracy sitting here.
Here's the teaser for the conspiracy episode. The Bank of Canada promises that interest rates are going to be low for up until the end of 2023. This is what they promised.
It's 2022.
Everyone goes out there and, as per their instruction, borrows, drives the rates through the roof, and then they go, drives pricing and inflation through the roof. Mm-hmm. And then they go, on second thought, we changed our mind. We're going to jack the interest rates. And now all of a sudden, you are extensively leveraged. You can't afford your bills. Who's going to sweep in and buy out all this debt? Right?
Did I not? You didn't agree with me last time I talked about this.
No, you talked about is it them
flashback clip from season 2, episode whatever.
This was very recently.
Yes.
Yeah.
And I was like, my conspiracy is I think the banks lined all this shit up, and you're like, no.
No, but you said they lined them up to protect us for themselves.
Are you getting paid off by the Bank of Canada? Are you in on this?
Listen, that's the next episode.
Chandler always comes from another meeting downtown before he gets to these podcast
I'm
recordings.
actually turning red here as if I work for the Bank of Canada. Conspiracy episode next time. We're not going to go too far into it, but
you're getting paid off.
I would love to get paid off right now. I am very much for sale, Bank of Canada, if you want.
I will say whatever you want.
Let me know. I love Big Brother. Yeah, so you're sitting on the sidelines a little bit, but you're working on the renos, pushing those.
I'm heavy pushing on the ones that I have now. Appraisal still came back even higher than when I thought originally again, which is amazing. So hopefully even if I can get 65% out, I'll be where I was when I bought them, expecting to get like 75, 80. The nice thing is I've beat all the rents that are in those. I'm doing 6% cap rates. So I'm feeling fairly comfortable, even if the rates go up a bunch more, that I should be able to survive. I'm not going to lie. It's playing through my head though. I'm like, wow, like I'm one of those people that got in this market when the market was hot. The rates were down. I leveraged my way up. And so overall, relative to my appraisals, I'm not that bad on loan to value, but it's still nerve wracking to think like if anything changes, which is what's happening now. It's funny that rates are shooting up this fast.
And you're renewing into fixed in a lot of cases, aren't you?
Exactly, yeah. And I'm like, should I be doing that? Especially with everything up so high. But on the flip side, I'm like, do I want to wait another year and potentially then be higher, and then I have to pay back some of the money that I got out? So I'm definitely like, man, why couldn't this be like 8 months later, because I would be done all of my projects.
Or why couldn't you have gotten them done 8 months earlier?
Or why couldn't have got them done?
You know what? 8 months ago, you would have said like, "Oh, I'm going to roll variable because they're saying that it's going to be this and blah blah."
Exactly. Based on what they said, I had some time, and to be honest with you, I did plan to have everything done by the end of this year, which would suggest that I would have been right on time and target for what I wanted, where I was supposed to be, based on the Bank of Canada. I made the kind of funny move and didn't realize that they would be in advance. And now I look back, I'm like, I wonder why those sellers were so keen to sell. And it's like they're all older gentlemen that have probably been through this before, and I feel like they could see the writing on the wall.
Of course, they could see it because when we were trying to get them to sell, we told them about the writing. It's like, gosh, have you noticed how prices of everything are going up? This is the pitch. Like when you talk to these old guys and you try to get them to sell their property, like, man, can you believe the price of oil these days, sir? Oh yeah, it's so expensive. Like, yeah, man, it's hard to make a living, isn't it? And you know what? I think insurance premiums are on the way up too, right? And they're like, yeah, they really are. You're like, yeah, that's right. And then they sell them to you, and it's like, oh yeah, all those things are 100% true.
I wasn't just bluffing; those are real things, and I now am facing those at a hard level. But what was I going to say? But yeah, anyway, so it's an interesting time to be going through all of this and just wanting to get it all done, get out what I can, and kind of just be prepared to weather the storm, because I do strongly believe this will be a storm.
For 12 months, probably, right?
I'm thinking 1824, if not longer. And my other thing that I keep reminding and trying to say, I was trying to say this in the last podcast, is when you look at, let's say, a 25, 30% drop in prices, that's a 6 or 7 year storm at the end of the day. Because you look at, if it's $100,000 today and it drops 30% to $70,000 in the next year, and then we resume average growth, which is about 4%, it's going to take another 6 years for that to go back. And they can fact check all my math.
I cannot wait for TikTok.
TikTok's about to blow it up, but Brad and Tristan better clip this properly so it has all the stuff in there. But if you compound 4% over 6 years, it comes out to roughly 30%. It's a little bit lower than that, so it's probably 6.5 years to get back to your actual price point. So that means if you buy a house, let's say, I shouldn't even say buy a house. If the price drops from where you're at today down by 30% by the end of this year, you will not see your return of your value till like basically 2030.
And just to put you on record here, are you projecting a 30% drop in real estate values?
Depends on the property, but yeah, I think so. I'm not saying projecting that overall, but yeah, you know what I am. Yeah, I think so. I would say 30% is a pretty average number to go down by at this point, because it went up by 20% year over year, multiple years. So to go down 30 is not that big of a deal.
Jesus.
And when we see what's already happened, like we're already experiencing probably about a 10%.
Yeah.
So like you're seeing it, we're out there in the market, we're listing these houses all the time, and we're seeing what stuff's selling for. We're listing and buying them all the time, and I'm like, yeah, well the neighbors went for 500 or 550, and I just bought this one for 500. Like that's 10% right off the hop, instantly. So I think there will be a lot of properties that'll face that. And again, this is another math one that I'm going to do. Hopefully we make another clip out of this and everyone can see this, is, yes, I know it sounds like such a small percentage, like, oh, it only went up by 75 basis points, it's 0.75%. But when the baseline was 1%, and let's say you're paying 1.5% interest on your loan, when they crank it up by 0.75, that's 50% more interest. So when you boil out, let's say your mortgage payment, let's say $1,000 of your mortgage payment is principal and $500 is interest. When they crank that up interest by 50%, that means that 500 is now 750. Okay, so now your mortgage payment went from 1,500 to 1,750. So that's a 20% increase off a 0.5 or 0.75 basis point increase.
And to be clear here, Bank of Canada meets again on January 13th, and conservatively,
Yeah.
they're going to raise it 50 basis points. There's a lot of talk right now that
They're
it's
going
going to
0.75. USA just did 0.75. There's no way. They just follow in the footsteps. And
Yep.
1 point, so that means we've had 3 rate hikes, 1.75%. That's higher than what the entire base rate was to begin with and what a lot of these mortgages sit at. And so your interest payment's going to double. So if it was $1,500 and $500 was interest, now it's $2,000 because that interest went from $500 to $1,000.
Yeah.
So now you're at $2,000 of a mortgage payment.
And a lot of markets have already built in a 75 basis point increase.
Oh, yeah. And there's another one to
So
follow.
that means, if all the smart money is saying, oh gosh, I think they're going to do 75 basis points. The other thing is they don't meet in August, I believe, right? So they're kind of looking at the calendar and being like, okay, if we're not going to meet again until September, we maybe get a little something here. And it's all about breaking the resistance to it. I can't stress this enough that they hadn't done more than 25 points in a raise for 20 years.
It was 95 since
So
we
to
last
do
did this.
50, 50, and now likely a 75 is not only shocking, but it is historically like not precedented in our lifetimes. And just to finish this off here, it was also exactly what they said they would not do. So anyone who's like, I can't believe I got a variable rate, I should have gone fixed. It's like, well, they literally came out and said, go with variable because we're going to keep these rates low for a significant amount of time. And if you were looking at, history, look at history to see what the future is going to bring. Well, historically, they'd never raised it more than 25 points. People used to look at variable and say, well, if they meet 8 times, even if they raised it every single time in the 8 times, they only raised it 25. So in 1 year, the most they could possibly raise it would be 200 points. They're going to crush through 200 points in, 6 months.
Leading up to 08, they did 400 points.
What's that?
Leading up to the crash of 08,
Yeah.
400 points. So, they're not afraid to go 200 points. The other thing, when you look at the interest charts, leading up prior to COVID, they were doing what they've always done, little quarter point increases, and they were leading up to this. And so, in my opinion, now they're making up lost time.
Speaking of which, we talked about this, and I was saying before we started, I wish we better cataloged our episodes previously. Anyone who might have listened from the beginning, you might remember a couple times where the Bank of Canada met, and we talked about this, and I said, there's so much inflation, and there's so much money that was just printed. If this was any other time in history, they'd be raising the bank rate because, that's how you fight off inflation. And the only reason they didn't raise the bank rate, so there are actually 2 reasons they didn't raise it. One, because housing was the only thing spurring the economy along. When all the shops were closed and everyone was at home
Construction was
and
keeping
you
everything
couldn't
alive.
leave anywhere, the housing industry, which includes construction, was the only thing keeping the economy afloat. That's why housing recently has been upwards of 85% of GDP growth in this country. So they were wary that if we stop housing, we'll really have nothing going on here. So they didn't raise the interest rate for that reason during the pandemic. The other reason is a lot of people took on other debts that were also tied to prime rates, right? So you get a bunch of people that are effectively unemployed, at least temporarily, who have taken on debt, and then you raise their rates, it would be disastrous. But in hindsight, they should have, right? We're now swallowing a much more difficult pill now than if we had incrementally addressed this as we went. And they didn't do it, and now they're jamming this through after the fact, and it's far worse.
This is where the conspiracy comes into play. Did
Future
they make
episode.
a mistake?
Whoa, I see what you're saying. Yeah, did they make a
Did
mistake?
they
Or was
make a
this planned?
mistake, or was this planned?
Because they just said borrow.
We need to have
borrow.
do 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 like the crazy spooky music playing.
Yeah. So, I have a number of variable products. I'm still personally rolling with those variable products because certainly now is not the time that I feel I want to be locking into fixed rates. But the reason that I took on those products, they were insanely low, and you were being told by the Bank of Canada that they're going to keep them that low. So why would you not do it? Also, if you look at the amount that I've been ahead over the last, call it 12 to 18 months on those variable products, it's been fantastic. And while they're now going up quite a bit, if you look at what the fixed rate is at now, which is like 4.8, probably going to be 5 or maybe over 5 by the time this comes out. There's still a decent little gap there. I think most of my variable products, because prime is like 3.7. And so if you're on a product that might be like prime minus 0.5, your variable's floating around 3.2. That's still a pretty darn big gap between the posted rate of 5% right now. So as these increases come, and now I think the Fed in the States, they're predicting is going to be 3.4 by the end of the year. They were expecting Canada was going to be around 3 by the end of the year. So we're talking another 1.5 points. That puts most variable products out there probably around upper 4s by the end of this year.
Yeah.
Right? Like that's still a decent spread. And even if it goes higher, maybe it does go to 3.4 in Canada as well. That's still, that's 2 points higher than we are now. That puts people around 5.5 on their variable rates.
Yeah, I expect exactly. I was expecting on a variable rate, you're probably going to end the year around 5.5, 6.
Oh, I don't see 6. I see
Fine, 5.
It also
5.5
depends what
for
your
sure.
variable product is. So we're going to talk a little bit when I get to my nerd out section about how variable rates, all that stuff is
Yeah.
kind of set. But let's bounce around here to some local news because there's some stuff going on. We've talked a lot about.
Yeah, go ahead, sorry.
Well, we've talked a lot about the housing issue here in Halifax, and this is a micro-focused issue here in Halifax, at least what we talk about, but it is a Western worldwide issue. Recently, HRM identified 4 park sites where unhoused individuals can tent. You saw that in the news?
I did see that. I didn't
Yeah.
read into it.
So they've identified 4 sites, 2 in Dartmouth, 2 in Halifax. They think this will be able to house 30 plus people between the 4 sites. This is because there's still a shortage of space. And they picked those locations based on they had to be 50 meters away from a school or playground or daycare. They had to be near public transit. They had to be near public washrooms. This, of course, to alleviate some of the concerns of residents while also making sure it was a good fit for the people who'd be living there. I think, and not to sound cynical, the reason they identified these specific parks is so that now if someone tents in a different park, they can say, you're not allowed to park in this one because we
Designated areas
we
that
have,
you
we
can
have
park
a
in.
designated one that you can, right? So.
Yeah, I don't know. Like, I get it. It works, I guess, in the interim. I'm not totally against it. I'm not for it. I'll be honest with you. I think the one that drives me nuts is they've allocate so much money towards all these programs and towards housing affordability and homelessness and this and that. And I feel like I see an announcement every 2 weeks for the government set aside another $2 million for this, and then another person donated $500,000, and I'm like, man, there is millions and millions and millions of dollars that are going into it. And I'm like, why are they not just building some shit? Why there's so many empty lots? Just go build a homeless shelter. Why in the world are they not just being all right, the government decided to take the $50 million that they have in holdings and they print money. They print money like it's nobody's business anyways. Mm-hmm. Build a homeless shelter. It's going to create a bunch of jobs. Build the structure and donate it to Red Cross, someone to run.
Well, this is the thing. They refuse to run it themselves, right? So it has to
donate the building to someone else. I bet you if they built the establishment, there's gonna be a bunch of companies that'd be willing to take it on to run it for them.
Yeah.
Versus this, it just doesn't make any sense to me. And I just keep seeing the idea of well, we hired so and so to do a study. It's gonna take 16 months. It's going to cost $400,000, and they're going to let us know if there's homeless people in Halifax. And you're like,
oh my
guess
God.
what? I can save you the $400,000 in 16 months, and I can tell you there are homeless people in Halifax.
I'll
and
do
if
it for $300,000.
I will do it for $300,000. And if you build a homeless shelter in any of the locations of any piece of land the government owns, it'll be full.
Yeah. Yeah, because they're over capacity now, and there's something like 6,000 people on a wait list for housing support right now. That's 6,000 people. That's a lot of people.
Build it and donate them. Build it and donate them.
I think
non-for-profits.
Yeah. This is a total digression, but I was going to talk about how they raise parking tickets. We were on here last week talking about how cool it is that they did this parking ticket thing where, if you spend the money in a local shop, then you get it refunded. And we're like, man, what a great idea.
Yeah.
Right. And then I think they bait and switched this because they did that, and then they just raised the cost of parking tickets by $10. So I don't know how those two things interact, and someone can maybe comment on this and sort it out. But I feel like it was a little hey, this is such a great thing. And then they slip in this $10 increase. And it always makes me wonder, I don't get it. Are we rich or are we broke? Because we're saying everything is so expensive and my gosh, maybe we should curb our spending. And now they're going to raise effectively what's tax, right? These parking tickets are taxed. They go to the municipality. Maybe they should curb their spending a bit, unless it's on something super important like housing. But man, we're trying to do all these things for people, and then on the other hand, we just tax them.
I wonder this all the time. I'm some days I'm oh, they're trying to make this into a rich province, and then they flip it with the tax. Same thing. They're trying to help out people that need housing, are facing housing issues, and then they flip it to be something else. I feel like it swings back and forth so constantly. It's so frustrating. So
I feel this is government, one hand not talking to the other.
I don't know. Anyways, the other thing, I'm going to move on to the next thing, and this is something to do with housing very heavily, again, on a hyper-local thing, but I believe you're going to see it across the country. And this is my other biggest concern outside of interest rates, inflation, is immigration. Canada's biggest business, and I've said this before, is immigration, because we don't let any other industry do anything here without just beating the crap out of them, taxing the shit out of them, putting in a ton of policies. So Canada's obviously a very big on immigration, and that's honestly what grows all of our main cities and really has been to the benefit of most of our cities. Some people will disagree with that, but I think it really has been to the benefit.
It's literally the easiest. Well, I don't know. It's one of the easiest ways to increase GDP, because if you shift your aggregate demand, you're going to raise your GDP. And one easy way to do that is just have more people out there spending money.
And if we don't do like standard industry, and our local population is not reproducing at a faster pace than they're basically passing away, we have to do something. Otherwise, we're going to be a shrinking economy. Yeah. So they have to bring them in. Like, there's no choice. Anyways, it definitely is putting a huge crunch on our housing, and that's what you've seen in all these other cities. And so now locally, Nova Scotia has what's called the Nova Scotia Express Entry Program, which allows people to get their PR within 12 months.
PR being permanent residence.
PR being permanent residence. And other provinces are, I think the shortest is about 24 months.
Yeah, it's 2 years.
And so what you're having is a ton of immigrants from other provinces moving to Halifax to get their PR. And this is similar to what happened in Ontario and BC. And there's a lot of people who moved there to get their PRs. And so it's giving us this big growth boom, but it's also putting a big pressure on the housing growth, or housing stock. And now they've actually cut that back. So it's only, they're changing the rules. So it's only going to be local immigrants that have immigrated to Nova Scotia that can do it, which is good in some ways.
And we're educated here.
And we're educated in Nova Scotia. So it's locals that have immigrated to Nova Scotia, have gotten educated here, are going to qualify for the 12 months. So first of all, there's a ton of people that have moved here from other provinces to go through this program that are getting cut. Only if they made their application prior to the start of June does it count. So there's people that have uprooted and moved here. So you're about to have not a huge, but I'd say a sizable outflux. It doesn't take many thousands for Halifax to feel it. And additionally, you're going to have less people wanting to come here now. Yeah. So like, this is the next thing that I'm like kind of freaking out about, and kind of why I'm sidelining is I'm like, well, if interest rates crank up, costs are up, and then the worst fear for me, I was like, this is all fine. It's all fine as long as the stock is being sucked up by all the people that we have. And now they're like, oh, well, let's teeter back on some of the people too. This is where I'm like, holy crap, things are changing. So
yeah, and
something to consider if this kind of continues moving forward. And with this happening and the forthcoming crash, we will likely change in our main federal party to a conservative party. And in general and historically, the Conservative Party has not been as pro-immigration as a lot of the other parties. And they might understand, obviously, that what it requires for the economy, what it means for the economy, but it hasn't always panned out that way.
Yeah, I mean, we started this podcast right around the federal election, and the People's Party of Canada, one of the things of their platform was that they wanted less immigration, right? And it was highly criticized. But this, economically, part of their argument had to do with, increasing pressure on housing and things of that nature. But certainly here in Nova Scotia, we've benefited greatly from immigration, not just in the last 8 years, because under McNeil, provincially, he made that a big push, but just historically, our city is very much, we're a port city, so you can go back as long as you want, is immigration here, right? Like, that's what's driven the economy here.
Blueberries.
Again, it's a double-edged sword, because you bring these people and that drives increased aggregate demand, but also our labor force, like, we are short laborers, period. In every sector, whatever you want it to be, but the service industry and skilled tradespeople.
They're giving the school away for free. You don't have to pay taxes, and they still can't get people to go. Yeah.
So
it's a generational shift.
Yeah, like we talked about this before. First $50,000 if you're under 30 years old. First $50,000 of income is going to be tax free if you go into the trades. So
did you hear that some trades programs are free now?
Totally free,
like completely free. I don't know exactly which ones they are. I'll look it up actually while we're talking here. Go ahead. But
yeah, it's apparently there's we're going to be short like 10,000 tradespeople by 2030. But so you need the people to come here and to fill this labor demand. On the flip side, they're also driving aggregate demand, which can increase some prices. So it's this tricky balance. But part of what's caused the inflation isn't just aggregate demand. We talked about this from the jump. It's not just that demand went through the roof. Supply was the big problem. This is also why I don't know that they're going to be able to address the inflation, because it's not like they can just change the cost of oil and blah, blah. But you could make an argument that increased supply would actually be a good thing for shifting, inflation back down if we could get things cheaper a little bit, which would rely on labor. So they're doing this as part of what is likely going to be a broader move towards slowing immigration. But it could backfire. Like all these things they've tried have kind of had the opposite effect of what they wanted. But just give some quick numbers, actually, because I did look them up. In 2019, we got 7,500 new permanent residents, and I think we talked about this on the podcast. 2020, obviously, that dropped off a cliff because of the pandemic. But 2021 was the new record at over 9,000 new permanent residents in Nova Scotia, and a big part of it was what you mentioned. They could come here and they could become permanent residents in half the time as other provinces. So
Is
they
that
did
just
come.
PRs, or is that people that are coming from other provinces?
That's just permanent residents.
Like that's people who immigrate to Canada.
Yes.
Okay.
They referred to them as permanent residents. So I don't know if they were meant in a, from the political stance or just like a.
Because I
lay
know a
term.
big majority from 2021 was people who moved from other provinces. There's
Yeah.
almost like a 50-50 of people coming in from other countries, and then the
Oh
other.
gosh, yeah, they guaranteed that'd be some from province and some from out of the
Yeah,
country.
okay.
Yeah, for sure. So very interesting here locally.
I'm fear mongering, but I'm scared.
Yeah, what else you got there?
So where are we at here? We had this one just on the continuation of these I guess being afraid is house sales month over month house sales are down 8.6%, which year over year is 21%, bringing us back to pre-pandemic levels.
Yeah.
Now that's volume of transactions.
Yep.
So things are slowing down. I feel, again, we've talked about this multiple times in the last few weeks. There's a lot of listings coming on, inventory spiking in a lot of cities. Here's an interesting one that I found really scary is in, I think it's Ontario and BC, there's I think they said all of Canada. There's 1.3 million empty homes in Canada. That seems really
What?
high. Let me look that up. But
Yeah,
I'm gonna double check that. I'm fact checking
That
that.
can't be right. That's not right.
No, how much money?
There's-
I'm telling you.
There's only like 35 million people here, and
I
not
know.
all those people live in houses. Maybe
sec,
half.
one sec,
So
one
that
sec.
means 16 million. You can't tell me that one in every 10 homes is empty.
Might be apartment. They might be.
Something's not happening. Well, Neil checks the Google web.
New data shows Canada still has 1.3 million vacant homes.
What?
At me, February 16th, 2022. That's before people were freaking out about this. But there's over 1 million empty houses out there, which is the really sketchy part. Because if you think back to 2008, that's
that
what everyone's
is
like.
sketchy.
The difference between 2008 and now is we have no empty houses.
Save that for the conspiracy episode.
So
All
I'm
these
just
things-
throwing this out there.
Okay.
Canada has 1.3 million empty homes with everything going on. There's a ton of listings coming on. Nobody wants to get caught holding the bag on assets that are super debt heavy. Again, just something to consider.
Changing lanes a little bit. Let's just talk more doom and gloom here. People that were clamoring for the Great Reset. Again, backtracking, when we talked about the Great Resignation, where we spoke about how people were kind of quitting their jobs because they had so many other options. And, we talked about unionization and the strength of the workforce. Well, the layoffs, at least the hiring freeze is pretty well almost universal at this point. Meta, which is, Facebook, they put on a hiring freeze. Intel, Salesforce, basically everything in tech
Amazon.
is on a hiring freeze. We hinted at some potential layoffs like Tesla, Walmart, Amazon. But especially in the startup world and the tech world, Wealth Simple cut 13% of their staff. 13%. That's not insignificant. So I think those people are like, yeah, the Great Reset, we're doing it. It's like, no, man, like you're out of a job. Like while interest goes up on your home.
You are it.
Yeah. But the tech sector and the startup sector is going to feel the pinch because oftentimes that market gets invested in because people are pulling from their other investments that are doing great. Like, yeah, let's throw some money at this startup here. And those startups, they burn money for a significant amount of time, 3 to 5 years before they make any profit.
At least.
Yeah, like that is the model. And when you have a contraction and people start being a little more careful about where they're putting their money, they're going to look at what
High risk investments.
Exactly. Or at least investments that even if they're not quote unquote high risk, they've got a high burn rate. Like they're just spending money hand over fist. So there's going to be a lot of cuts.
People sell their crypto, they sell their tech stocks, and they sell their Mustangs.
Yeah, smoking deal on that Mustang. And then, we already talked Bitcoin, Ethereum getting trashed. I want to return back to
Let's do
interest
some
rates. Oh, what do you
Well,
got?
before we go to interest rates, I want to talk about something a little bit less, a little more cheery.
Okay, that's good. Yeah.
So, metaverse.
Yeah.
Metaverse
our old
ticks
friend.
on. Nobody cares about the interest rates in the metaverse. They're meta interest rates. It's all fugazi. Nobody
Yeah,
cares.
exactly.
But no, Wendy's, like the burger chain Wendy's,
I'm familiar.
has built has built a castle in the metaverse for their breakfast sandwich. So it's the breakfast castle.
Imagine
There's
the
some-
Burger King just comes over and takes it over. He annexes the Wendy's.
There's some games in there. There's some obstacle courses.
Really?
And I believe there's something in there that you can win a free breakfast sandwich. So if you're looking to do something this evening,
Game on.
yeah, you go in there, you can game, and you can have some free sandwiches in the next day, potentially, if you're any good at the game. The other thing I want to say, this is someone trying to address some of these things that we're facing.
Yeah.
On a more real note, is a company called Naked House. And they're based out of the UK, and basically, in an effort to address housing affordability and the issues that everyone's facing, they're basically creating a package for a home that they're calling the Naked Home, and it's just super, super basic. It's effectively just a box, and the idea is that you buy that, and then you build the house out as you have the availability and the money to do so. So it
I
literally
love
says
this.
no walls, no drywall, no finishes, basic plumbing.
No financing.
Yeah, true enough. Double high ceilings, so you can build a second story if you want to within.
Oh my God. Okay.
And so the idea is that they're designed that you can grow into them with affordability in mind. And so literally you're basically buying a box and you're working your way into it, and they're trying to address the fact that affordability is so crazy out of this world. And some people will be like, you know what? Just to own, I would buy something like this.
yeah.
And build it out. And honestly, for a lot of young people, I can see a lot of young couples being like, you know what? Instead of waiting 10 years to try and get my foot into like a tiny little condo or some old beat off townhouse way outside of the city, maybe I can buy this somewhere closer to the city, and it's a decent sized space, and we can build it out as time goes on. This might actually also lead to a transition back to people like being in trades and stuff, because people start to have to actually do some of this at home. Like, well, instead of having to hire someone to build it out, we'll watch a YouTube video DIY and we'll build a wall inside of our house.
Everyone's probably seen those images that get floated around. I think it used to be able, through the Hudson's Bay company, order a home. Was it Hudson's Bay or Sears catalog?
Sears had them and Eaton's had them.
Yeah. You could order these homes from a catalog that would arrive, and you built the home yourself. And they were like $1,500.
Chandler's first duplex.
Pretty much. Like, I think that's what that reminds me of. Right, that used to be a thing. As crazy as it sounds, you could order a home through a catalog. It would arrive, and you would put it together with your friends and family, and you would build this house. And the challenge now is meeting code requirements and land costs still being so high and all that.
Then I don't think they were doing it for an affordability.
No,
I think then it was more common for people to be hands-on with their own homes,
100%.
involved in the construction process.
Yeah.
And a lot of people had their own builders who built homes, and it wasn't as like nowadays it's very structured. Every city's got like builders that have to be licensed and warranted and approved. Back then, I feel like a lot of people were like, yeah, I built my own house.
100%.
And so this was like a kit to allow people to build their own houses. And again, I don't know that it was an affordability crisis-based item, because I always wonder about that. I'm like, is this something that we've had before? Like when I see those kits, I'm like, hold up. Are we just going through a whole repeat in history where it's like...
Well, a lot of those came out kind of post-World War II, right? Like, but...
when there was a giant boom.
Yeah, and post, Depression era. Yeah, because at least that's here locally, right? Like a lot of those are 50s era homes or like late 30s era homes. But that's super cool.
Yeah, this was I saw that and I was like, you know, that's an interesting one. There's a lot of other projects, and I actually have a project on the go that I'll release hopefully on here in the next month or two, with something kind of similar. I'm hoping with some stuff like that. So I think there's gonna be a lot of changes in general just with how people operate from this. Again, I try not to see I'm like, is this just recency bias where this is just happening now? Or is there a general change? Like, is this different than it has been before, where the difference is the costs are high and the inventory is not there? But now I have all this doubt in my mind where, having seen that, where there's 1.3 million vacant homes in Canada, I'm like, maybe this isn't any different than what we have had before, and maybe we're just feeling an illusion based on the way it's being presented to us. Right? Like, I don't feel like I see that news article anywhere. That article is from February, and I haven't heard anyone talk about it, to the point where you made me even question it. And I went back and looked at it, because when I first saw it, I was like,
still doesn't sit right with me.
yeah. But it breaks them down by province. Like, it shows Nova Scotia having around, based off this chart, roughly around 40,000 empty houses. Ontario has 500,000.
I'd love to see like
has
a breakdown of
180,000.
it. of like how much of those are secondary properties that sit vacant some time, how much is new. Like I'd just be really curious to see.
There's definitely a
exactly that.
high percentage of them being secondary properties.
Yeah.
And it says like resort towns carry the most vacant homes. So that makes total sense.
But it speaks to a frustration out there that people would feel, and maybe that some of the skewed data, like it's not an accurate measure because like supply is being hoarded a little bit in some way. But
Even if that shrinks down though, like we said, like that's an enormous number. So even if you shrink that by like half or 75%, that's still a scary number of vacant homes.
well, people unload homes, right? Like so, say half of those. Say even 25% of those homes get unloaded because people no longer can service the debt on them.
I would say the same principle we just said. What gets sold first? Your cryptos, your high risk investments,
The cottage.
things you don't need. You're going to sell your house or your cottage?
Yeah.
You're going to sell your cottage. So those things start flooding the market, and depending on where you're located, like they're going to impact even your local market, right?
Yeah.
So
I'm going to talk about two things here, just when we're kind of shooting around different topics.
hit me.
Two things that are going to be two words that are coming up more and more. I see them online, so I thought they're worth mentioning. The first one is shrinkflation. And no, that's not what happens when Neal gets out of a cold shower. No,
That's a disappearing act, Chandler.
Oh my god, I love it. Oh, that's so funny. No, shrinkflation. Well, everyone may have noticed this. Like, you pay the same amount for the bag of chips, or you pay the same amount for the bundle of bananas, but all of a sudden there are less chips in it, or there are less bananas.
Bananas by the pound, so that was a bad example.
Okay. Well, all of a sudden they start.
You mean like a package of berries? A package of berries is a prime one. I feel like growing up back in the good old days, a package of berries was enormous, full of berries, huge, like the size of this lamp sitting on our desk.
Yeah, and maybe
now
you
they're
paid-
like these, and it was $2.99.
Yeah.
Now they're still $2.99, but it's this razor thin package that's only the thickness of one berry.
Exactly. So you pay the same price, so that doesn't appear, at first glance to be inflation, but the actual what you get for that same amount of money is less. So it's called shrinkflation. You might see that around, and you're probably going to see some memes because there was a great one on shelves. It was like 63 in this package for one price, and then right beside it there was one that was like 61.
It's actually
They're being sold together.
It's infuriating. Two things I want to say. I was using I'm going through an immunotherapy allergy treatment thing because I'm allergic to dogs, and I would like to get a dog, so I'm doing this right now. And even that, I'm imagining at one point the vial used to come full, and now I'm getting to the bottom of this vial, and the whole like center of the vial, like the bottom is like half an inch thick, and then it's like nippled all the way up. So like it looks like you're getting a full vial when you get it, but it's actually they filled it all with the glass, and the inside of it goes all the way up. It's like a wine bottle. The bottom of the wine bottle goes all the way up. I'm sure there's some purpose for that as well.
Yeah.
But there's also an aspect of like making it seem more than what it really
Totally.
is.
Yeah.
Same like perfume. Perfume's super bad for that. The glass is like an inch and a half thick,
Yeah.
and the inside is concave, and it goes all the way up.
Yeah, well, these are all examples of shrinkflation where you're getting less for the same sticker price. So you as a consumer don't really notice, like, oh yeah, I buy these every week and they're the same price, but now they're smaller and smaller and smaller.
Last thing I want to point out with that, and they're going to do really well during this time, and the person who uses shrinkflation the best and uses it at all times of the year, dollar stores.
Oh yeah,
They are the master. You go there like, oh, it's only $1 for this, like a sponge, and like, oh, I saw that same sponge at Superstore for $1.99. Grab that sponge from the dollar store, go to the superstore. The one at the superstore is probably bigger than the dollar store. The dollar stores will shrink up the packaging and make it look like the exact same, and you won't notice because it's on the shelf there, and you obviously can't have the two right in front of you to compare. But everything they have there will be slightly smaller, slightly less in the package, but they'll give you the same size packaging to make you think that you're getting the exact same product for $1 or $2 or whatever it is. They are the masters of it.
Yeah, it's the bait and switch. So that's what shrinkflation is if you see that out there, which you will, but you might come across the term. The other one is stagflation. And again, we talked about this in an episode a long time ago. So I'm like, man, we're going to have stagflation. We're going to have stagflation. And typically, when inflation is high, and that's when the economy is humming along, you've got really low unemployment. And we've been in here doing episodes being like, man, unemployment dropped again. Like there's, that's great. The employment rate is super high. Inflation and inflation as it's high, unemployment is low. And by contrast, when inflation is low, the economy's not growing as quickly, unemployment is higher. There's a rare exception to that when there's what's called stagflation, when you've got super high inflation, but also higher than normal unemployment. And that's what we're headed to, because
Not a great combo. Not a good, rare scenario.
it's the worst thing. Everything's more expensive and more people are out of work. And it typically is caused, like if you looked at history, it's when there's gigantic shifts that kind of cause a contraction in supply, because all of a sudden there's something that's driven all the prices up with no real change in aggregate demand. And as a result of that, there's job loss, but the pricing is still going up and up and up as you kind of slide leftward on your aggregate demand, aggregate supply curve there. And that's where we're going right now, because the big increase in this case is oil. And this is why I don't feel these central banks can control inflation the way they think, because oil is not just at your gas. Like, it's not just when you fill up your car. That's not the real cost of oil as it trickles throughout the economy. It's everything. And
everything you buy is shipped.
Yeah.
Everything you buy, everything you touch, everything you do is goes through oil. Even a lot of the products are oil-based products. So it impacts absolutely everything that you're going to go through.
And no interest rate is going to suddenly stop like the Russia-Ukraine conflict. Like, there are things beyond the control of these central banks. So the question then becomes, how much are they going to break as collateral damage by jacking up these rates to control inflation, which, newsflash, they may not be able to control. So stagflation is this rare occurrence where inflation is still going up, but unemployment also rises as well. It's a bad situation.
It's a recipe for disaster, and I honestly think there's definitely going to be, like, I think this is going to be a longer blowout than a lot of people are anticipating. I'm just sitting here thinking, like, is this like, again, it's been all roses for so long, and I feel like it got extended by the fact that COVID kind of like gave us this extra bump. Is this going to be like, for anyone who's new or just started getting into the game or building their business or getting their investment portfolio growth during this most recent growth window, is this going to be like when you fall off your bike and then you're a little more scared to get back on and do something? Like, you know what I mean? Like if you're a little bit ballsy and you go off a jump and you break your arm, then every time going off that jump, you're going to be slightly less confident.
Well, think of how many people were so bullish at the start, like when the economy started humming. They're like, oh, I'm branching out on my own. I'm doing this now. I'm getting my real estate license. Things are up. Like,
but this is why the previous whenever I listen, I mean, there's definitely some that listen from the previous generation, and they're so concerned about a lot of people getting into business. And I look at like even the advice and some of the people that talked to me as I was getting started, and they're like, well, you got to be careful. You got to be careful. You got to be careful. I'm like, oh my god, but it's all roses. Everything's great. Everything's amazing. Like, let's do this. And now I'm like, well, now I can maybe see why a lot of them had those concerns, because maybe they've seen this cycle before, and it was triggered by different things. So they're not necessarily lining up the fact that this is the exact same concept of what's about to take place, because it was triggered through different stuff, whether it may be a war, an oil crisis, an energy crisis, whatever it is. In this case, we might have all of them, like a war, an energy crisis, and a real estate crisis.
Yeah.
But so they're removing the direct connection so that the previous generation's unable to give that guidance to the younger gen. But the younger gen's about to find out, like, this is why everyone's concerned. And that's why a lot of people push towards, like, get an education and get a standardized job.
Well, when you think of, we've been out there selling houses where, we got the junior version, and then the parent comes along. And what's one of the things the parent talks about when it comes to mortgage rates? Well, back in my day,
it was 39%.
Yeah. And so what did they do? Like, they saved, they put more money down, they did all these things. And they're trying to impose that life experience onto these kids who all they know is a debtor existence, and are like, well, interest rates now are this, and things are different now, mom and dad. Like, maybe this is that little shock to the system that changes how we then talk to our kids 20 years from now when they're taking on debt. But I don't know.
And
we'll see.
This is the other thing, is the idea was that you could, for like the last 10 years, you could always take on debt and make a higher return somewhere else.
Yeah.
But it's quickly getting to a point where it's like, maybe
no, that's an interesting point.
Make a higher return on this money, and so maybe it's better to be paying down the debt, which takes more money out of the cycle, right?
Yeah.
Hey guys, thanks for listening up until this point. Coming up, we have interest rates. I know we said it might be a little bit boring, but Chandler and I get into a heated debate, and it's super fun. There's a lot of stuff to learn. Please like, comment, subscribe, and keep listening. Thanks.
Man, lots of crazy stuff covered here. I don't know how we're doing for time. If you've listened this long, you obviously like it, so press the like button. Yeah. But you got something else? Because I want to nerd out a little bit on variable rates for a second.
No, I had a hypothetical, but we're at about 50 minutes, so like let's.
Well, this isn't going to be that complicated, but we've gotten this question so much about variable rates, and one of the challenges with Bank of Canada struggling to find effectiveness is a lot of people just don't know much about rates, and they respond almost more to the narrative out there surrounding the sky falling as opposed to like the actual impact of the rates. But people are going to feel them. If anyone was curious, just wanted to quickly break down how the bank rate trickles down to variable rates, because that's the closest connector you've got is the Bank of Canada rate, the overnight rate, and your variable rate and your line of credit rate and things like that. So all the banks in Canada, they keep a little bit of money, like their reserve money on hand, and then they have a bunch of debt effectively floating out there, a bunch of money that they've loaned out to people. And you can imagine that in theory, if everyone went down to the bank and said, hey, I want all my money out of my bank account. And if everyone did that on the same day, the bank would quickly realize they don't have enough money to cover all that. So what they do is they keep some sort of reserve ratio that, okay, if we've got, $1 billion total, and we're lending most of it out, we want to keep like 15% of it on hand, because at any given time, not everyone's going to come in and get their money, but enough people might come in that we might want 15.
Policy that dictates that liquidity.
Yeah. There is a minimum requirement, but there's just their own kind of fiscal planning of like how much do we want to keep on hand. But if you realize any given day, I might go and spend my Scotia Bank money at an institution that redeems it from a TD account or vice versa. And these banks effectively every night have shortfalls and surpluses as they short-term loan each other money. So I go to an ATM that's branded RBC, I take the money out, but that money's actually with me at Scotiabank, and so on. So there would be a deficit there between the two banks. When the Bank of Canada sets its rate, it is effectively saying the rate that they would take money and lend money to the big banks, right? And as a result, those banks, when they have their shortfall from one another, that they effectively are loaning each other money, that is based on the same rate that the Bank of Canada loans and borrows money from those banks. So the bank, when they set their rate, their overnight rate at 1.5%, that's saying, if one of you is short money to the other for this night, you're going to pay interest of it of 1.5%, because that's the same as what I would charge you. Yeah. So that's the basic deal of the overnight rate. And from that, the banks then set their prime rate. So this is the rate that they're then comfortable charging their best clients out there, right? So they say, okay, if I have shortfalls every night and I get charged 1.5% interest, what interest rate do I feel comfortable floating around there to my best clients?
7.99. At least that's what they give me, and I'm one of their better ones.
Right now, the average prime rate in Canada is about 3.7% if you kind of summarize all the major banks. So they know that if they have a shortfall every night between themselves and other banks, they have to pay 1.5% on that. So they're comfortable lending out to their best borrowers at a prime rate right now about 3.7%. As the Bank of Canada rate goes up, they raise their prime rate. Now, if you are on a variable product, you have a variable mortgage, you have something that is quoted to you as prime minus X. So you might be prime minus 0.2, which since prime is 3.7, that means your current variable rate would be 3.5. Or maybe you crushed it. Maybe you've got like prime minus 0.75. So you could still be running it like 3.7 minus 0.75. You could still have a variable rate at 2.95. As the Bank of Canada raises its overnight rate, it doesn't affect your discount, right? Your minus. What it affects is the prime rate that the bank is out there. And by contrast, you might have a line of credit that's prime plus something, and so on. So that is how the Bank of Canada rate, which is the behind-the-scenes rate for when the banks effectively borrow from each other every night, that's how that impacts the prime rate and, in turn, your mortgage. Maybe no one cared about that, but just something people should know.
I'm kidding.
God.
I'm kidding. No, that was good. That was a good explanation. Yeah. I liked it a lot.
Which is very different than fixed rates. And fixed rates are on the rise, but for kind of a different reason.
Making me think that my banker's screwing me.
Why, what's your prime?
I'm messing.
Yeah. I don't. So
every product's so different, honestly, and they swing them around, and so it's hard to honestly keep up with all of it, because like for construction, they end up getting like they have to factor in risk and the overhead involved in running these products and all these other things, and so it's with this many different products out there, like it's hard to honestly keep it all in line. But again, I'm just going to quickly spew why I, again, am considering fixed rates if I don't intend to do anything with the property. It's to avoid that stressor that I have a renewal coming up that I'm not going to be ready for, or that they continue to raise rates up that 400 basis points like they have in the past, right? Like, yeah, fine, if they only go up 200 basis points, I'm like, all right, yeah, variable makes more sense. But I don't know if I'm comfortable enough to bank my stuff against that, knowing what I've seen in the past. Like, if you look at the interest rate hikes, like the chart in the past, lots of times they've done over 400, 500 basis points over the course of time. Not in 2 months, over 2 years, 3 years, but it's just, I think it's something to consider, especially if you're not planning to do something with this property, or if you're in your head like, I'm going to hang tight, then I would probably hang tight by doing a fixed and doing like a 3 year or 4 year, because I think that's when you'll see the rates come back down around. I don't think like a 1 year kind of freaks me out, because I think in 1 year from now, I don't want to say I know, rates will likely be higher in a year from today.
But
A fair bit.
a lot of people that are panicked right now don't even know what their actual variable rate in this moment is. Right. And you gave all these examples of like, oh, if this changes, it goes up by 250. If this change goes up by 500, so on. But I'm telling you, everyone listening to this that's on a variable rate right now, you are worst case scenario 3.7%. Most of you are likely 3.2%. And by the time this airs, the fixed rate for a residential mortgage, I'm not talking commercial, I'm talking residential mortgage, is going to be around 5%. And I know there's a pretty big difference, or I know that variable rate is going to continue to rise, but 3.2 versus 5%, I mean, that's a 1.8 gap. That's 180 basis points. We've already gone up. We've already gone up 50, 50. We're going to go 70. We're already gone up about, we're effectively in 4 weeks' time.
In 90 days, 120 days, we're up 175 basis points, which is why I'm saying it. To fix up another 180 is not a big deal.
Right, but I'm just saying that is still just to get us effectively to even where the fixed rate is today.
Yeah, 100%.
Right? Like, that is a lot. And people griping like, well, I can't believe how much it's gone up. It's like, right, so then you're going to voluntarily pay an extra 150 points. Like, now isn't the time, in my opinion, to lock in.
I mean, you should have done it in the past, but I don't think we're anywhere near. I don't think you're anywhere near the top.
I hate that argument of like, should have done it in the past. Like, they were literally saying, we're not going to raise the rates. And so you would have to have been like, I believe that Bank of Canada is
there was no way to know. But my thing is, you're coming, in my opinion, honestly, coming from a place of comfort where it's like, if those rates go up, you can service that debt as those rates go up. I don't think a lot of people have that comfort level to service as it goes up.
Dude, if you can't service 3.2, how are you going to opt into a voluntary 5%?
I'm not saying no. I'm not saying they can't service a 3.2. What I'm saying is, if this goes up another 200-300 basis points, and now this is 5.5, 6, 6.5, 7, then they can't do it.
But that's you're talking an additional 400 basis points on top of the 175 we already have.
And I also, you can beat 5. I don't think the spread's that big. If you, depending on what package you go with, that's the other thing. You're going, I think, with like a 5 year, and they're going to give you a 5 to try and cover their ass. There's also a reason that they're doing a 5. There's these fixed rates, like, they're doing that because they have to hedge against the fact that they know that the rates are going to go up a bunch. If they expect them to go down a bunch, they're not going to put your fixed term at 5% because it's just not going to happen. They're doing a 5% because the rates are going to go up a fair bit more. Like, that's an indicator in itself. If you're going to get a fixed term and they're way up, all those numbers on the fixed term, that's a guaranteed sign that they're going to keep cranking this number.
Totally, because there is a relationship between fixed and those prime rates, like I just talked about. But the fixed rates are more related to
the other thing is,
yield.
someone might be like, look, with this, I know my payment for the next 3 years is going to be $1,500.
Right.
With this, I can't go to sleep at night because at the end of every month, there could be another $200 tacked to my mortgage, and it might be $1,500 in 6 months from now, and in a year it could be $1,800, $2,000. And not everyone, like, if you're on a standardized pay system, you don't have the opportunity to increase your payment and how much money you're making.
So let's unpack this hypothetical. Right, someone's at 3.2% right now, right, and let's say that works at $1,200 a month on their mortgage.
Yeah.
I wish we could calculate these super quick, but say they go to 5%, they would opt into maybe say they opt into like a 4.8% fixed right now. That payment is going to go to like $1,600.
Yeah,
I understand, like, you get security at that $1,600, but it is going to take, let's see, 180. I mean, like, if things go badly, I honestly feel that 1,200 would cap out maybe at like 1,750 for a short period of time, then start coming back down. And that's not going to be, that would be in 6 months. So you get this better rate, you save up a significant amount in the interim before it hits that high. Like
I just had someone just do one right now. This is even on commercial money. And a 5-year fix was 4.5. You're making the spread between your fixed and your variables way higher.
Man, you Google right now residential mortgages and it's like
But they
4.8.
never do that. When you Google them, that's not the actual rate that you're going to walk out with. It's always lower. Always, those posted rates are not.
You get a commercial at 4.5% for 5 years?
5-year fixed commercial 4.5, 4-year fixed 4.41.
That's actually pretty
3-year 4.27. So that's what
Those
I'm
are
saying.
pretty good, actually.
That's what I'm saying. And
Yeah, those are pretty good.
that was a commercial mortgage. It would have been lower on if they did it residentially. So that's what I mean. Like, I don't think the spread is 180 basis points or 200 basis points. I think
Well, part of that is going to depend, you're right, on like what your prime minus is on your variable. And it is going to depend on how good of a borrower you are on your residential. Man, but if you go across the major banks right now, I don't know if you're going to get better than 4.75% on a residential mortgage right now. I just don't think you are. But anyway.
yeah, they're
those
posting
returning calls now.
No, I'm looking at what they are right now. So they're posting, but I think you can beat this, like you're saying. So it's 5% and 3.3. So it is 170 on their website, but it never is that. Like every time I've gone and gotten a mortgage, their post is 5, and my guy's always like, okay, it comes out to actually be like 4.6. Like they can always beat those posted rates.
Yeah.
Those are, it's like it's a sales job. It's anything they offer. I'm trying to find one of these.
I just
websites.
think there is meat on the bone there.
Yeah, look, so
but like it's hard to say people are like, I can't
Here.
afford it now at 1,200. You want me to voluntarily opt into 1,600?
Here, look. This is what I'm saying, and this is something that I've actually found more accurate. It's ratehub.ca. Fucking free ads. We're doing 2 today, but 5-year fixed rates. The first one, 3.69% residential lender. Second one,
You know that's some
second one,
crazy
5-year fixed, 3.84%.
Yeah, man, those are bait and switch. No one's getting those.
Bank of
but
Montreal,
not here.
4.5%. Desjardins, 4.6% for all 5-year fixed.
Yeah. So BMO and Desjardins are, more credible lenders than whatever the first
They
two
are,
Yeah.
but still.
But those are going to be things like if
no,
you
but
close,
I found the rate hub numbers are the actual numbers that you walk out of the bank with.
those are going to be things like you have to close inside of 30 days and you have to have this and have to have that, blah, 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 blah.
They'll have some.
So
But they might have.
if you
some
want to hedge and
contingencies.
say 4.75, I still think there's a spread there.
Yeah, there's
I'm still
150
comfortable.
basis points. But
Also, 3 years from now, if you want to refine, you're into a 5-year, right? That penalty is going to be more.
It depends on what
than
you.
everything.
But if you're in
that
a
you just
residential
saved.
property, or you're not necessarily like you're an active investor, but you're not like constantly moving and shaking and buying a property every 3 months, like we are. I don't. You know what I mean? Like, and you do
I
need
see
to
both
cover your.
sides
You
of
need
it,
to
but
cover your
yeah.
bases. Is my thing,
Yeah.
man. Like, if we have a shortfall, we're like, all right, we're gonna go out and work really hard and clean that shortfall up.
Yeah.
It's not everyone's that fortunate.
Well, then those same people can't voluntarily opt into the shortfall.
I guess.
Like you know what I mean? Like, so this, and I guess that is all to say that people are between a rock and a hard place. But the first thing I tell people is
Sell all your real estate.
call me. Let's sell it. But no, know what your actual variable rate is. Some people be like, oh, my variable rate, like, I don't know what to do here. What are your thoughts? And I go, well, what's your variable rate? Like, yeah, I don't know. It's like, well, man, like there are people out there who've got a variable rate right now that's still under 3%.
Oh yeah.
Right? Like, say you have prime minus.
Yeah, there's 2.8s and shit out there.
Like,
Yeah.
so you're going to tell someone, like, even if you get one of these Neal's, a rate that Neal got off the internet.
Call me, I do mortgage brokering.
Like, say it's 4.5. You're going to voluntarily opt in from like 2.9 to 4.5 because you can't pay the 2.9, so you feel really good about having the 4.5 for the next 5 years.
I mean, you're saying
And a
that
penalty.
now?
And you get 2 years in
I
that
hope
and realize,
we're
oh,
going to
crap,
clip this clip
now I
in
need to
18
sell
months
it.
from now when fixed rates or variable rates are at the same rate or higher.
I can't wait.
I can't either.
We got to catalog this stuff.
Yeah.
All right. We are going to talk about fixed rates because fixed rates are not really directly related to the overnight rate. They're related to bond yields. We can talk about that another time. Yeah. Thanks so much for listening. Smash, like, boom, all that good stuff.
Shoot us messages like you guys are. Again, appreciate everyone following along. Hopefully this is helpful. That's our intention with this, is to try and unpack some stuff, just get our opinions out there. We are not financial advisors, so don't do either of the things we just said. And
Do both and neither.
Exactly. Thanks for listening.
Hashtag shrinkage. Thanks so much for watching the episode. I hope you enjoyed it. If you did, press like. Don't forget to subscribe. But also check us out on Instagram and TikTok. You can find all the links below. Thanks again for checking us out.
Hey guys, I know everyone's got a super packed day and it's hard to listen to a full podcast sometimes. So we created a clips page where you guys can get condensed information that's really important to kind of keep you up to date. So take a look below. We have links for 2 clips right away. They're also in the description.
When I was broke, I had rich habits. When I was broke, I had rich habits.